All right, let's talk about a word that gets thrown around a lot, one that can really free people out: recession. We're going to break it all down: what it is, how you can see it coming, and, what it actually means for regular folks like us. You hear that word everywhere, right? Recession. And you probably think, okay, that just means the economy is in the tank. And yeah, that's the gist of it. But the actual definition, it's a bit more complicated. And believe it or not, people even argue about it. So what are we really talking about when we use the R word? Okay, first things first, you have to get this one big idea. Economies don't just go up in a perfectly straight line. That's just not how they work. They kind of breathe. They have good times and bad times, almost like seasons. So yeah, think of it less like a rocket ship heading straight for the moon and more like a roller coaster. It's all about those ups and downs. And that up and down pattern, well, economists have a name for it: the business cycle. It's a super important concept because even though over the long haul the economy tends to grow, the journey to get there is, well, it's bumpy. It's always this series of good times, expansions, and then the tough of times, the contractions. So, this roller coaster ride we're on, you can break it down into four main parts. First, you've got the expansion. That's the fun part, the climb up the hill. Everyone's spending money, companies are hiring, things are looking good. Then you get to the very top. That's the peak. But what goes up must come down, right? So next is the contraction. That's the downward slope, where things start to shrink and slow down. And finally, you hit the trough. That's the absolute bottom of the dip, just before the whole ride starts all over again with a new climb. Okay, so now that we've got that whole cycle in our heads, where exactly does a recession fit into the picture? Well, it's not just any little dip on the roller coaster. It's a really specific and pretty significant part of that contraction phase. So let's get into the nitty-gritty of how economists actually define it. The big idea here is that a recession isn't just a blip, one bad month of data. It has to be a sustained downturn. And it really boils down to two key ingredients. First, the economy itself is shrinking. That's what they measure with something called real GDP. And second, a whole lot more people are losing their jobs. But, and this is a big but, here's where things get a little messy. You've probably heard the simple rule of thumb, the technical definition: 2 quarters in a row where the GDP shrinks. The media loves this one because it's easy, but in the US, the official call, the one that really counts, comes from a group called the National Bureau of Economic Research, or NBER for short. And they're not just looking at one number. They take a much broader view, searching for a deep, widespread slump across the whole economy. They're looking at jobs, income, what factories are producing, the whole shebang. So the really key thing to remember is this: a recession isn't just a single point in time. It's a period. It's that whole downward part of the roller coaster ride, from the very peak of the good times all the way down to the bottom, the trough. And get this, the NBR doesn't predict it. They actually look back at all the data after the fact to say, okay, that's when the recession officially started, and that's when it ended. Wait a second. If the official call only comes after it's already happened, how in the world is anyone supposed to know if we're heading for one? Well, that's where economists turn into detectives. They're constantly sifting through all the data, looking for clues, for red flags that might be warning us that a storm is brewing. Take economist Mark Zandi, for example. He's been pointing to 3 big red flags right now, all in the job market. First, he's saying that job growth is basically grinding to a halt. The headlines might look okay at first, but when they go back and check the numbers, they keep getting revised down. Second, it's not just a few tech companies laying people off anymore. The job cuts are widespread. We're talking over half of all industries in the US are cutting back. And third, that official unemployment rate, he says don't trust it too much. It's what's called a lagging indicator, meaning it only starts looking bad after we're already in trouble. And here's another classic warning sign, one that gets financial folks really talking: the inverted yield curve. Now, this sounds complicated, but the idea is simple. Normally, if you lend your money to the government for a long time, say 10 years, you get a higher interest rate than if you only lend it for a short time, like 3 months. Makes sense, right? But every once in a while, that flips. It goes upside down. You get paid more for a short-term loan than a long-term one. And that weird situation, that inversion, is basically the market screaming that it expects the economy to get a lot worse in the near future. It's not a perfect predictor, but man, it's got a scarily good track record. Okay, so we've talked about GDP and yield curves and all this economic jargon.
But let's be real. This stuff isn't just numbers on a screen. It has a huge impact on our actual lives. It changes how we think, how we spend our money, basically how we live day to day. So, what does a recession actually feel like for you and me? Honestly, it's a vibe shift. It's a change in psychology. That feeling of uncertainty just starts to creep into everything. Consumer confidence takes a nosedive, and we all start asking ourselves those tough questions we tend to ignore when things are good. You look at something and think, do I really need to buy this right now? Or, is there a cheaper way to do this? And those questions, they lead to some really predictable changes in how we all shop. First, we slam on the brakes for the big stuff. That new car, the kitchen remodel, the fancy new TV. Forget about it for now. Then, we all turn into professional bargain hunters, right? We're clipping coupons, searching for promo codes, and waiting for the sale. And that brand name stuff we've always been loyal to, suddenly that generic store brand looks pretty darn good. Loyalty goes out the window, and value becomes king. And we're not talking about a small change here. One study from McKinsey found that during a downturn, about 30% of us, that's nearly 1 in 3 people, will switch to cheaper brands. But here's the crazy part. A lot of those people discover they actually like the cheaper stuff, and they never switch back, even when the economy gets better. A recession can literally change our spending habits for good.
And that brings us to a really important point. The damage from a recession doesn't just disappear the minute the economy starts growing again. No way. These things can leave behind some deep, long-lasting scars on people, on companies, and on society as a whole.
If you look back at history, you see that no two recessions are ever the same. They each have their own personality. Just take a look at Australia's history, for example. In the 70s, it was a massive global oil price shock. In the 80s and 90s, it was caused by moves to fight off super high inflation. And of course, in 2020, it was a worldwide pandemic that shut everything down. Every single downturn has a different trigger and leaves a different kind of mark.
And those consequences, they can stick around for a very long time. Think about it. Someone who loses their job might struggle to get back in. Maybe their skills get a little out of date. When a business goes under, especially a cool, innovative one, all that potential is just gone forever. Meanwhile, governments go deep into debt to try and fix things. And the real human cost, the toll on families, on their health, on their kids' education, that can create ripples that last for a generation.
Which, of course, brings us to the biggest question of all. We know recessions are painful. They cause real, tangible hardship. But if they're a natural part of this economic roller coaster we've been talking about, are they just inevitable? Are they the price we have to pay for all the good times, for all the growth? That is a huge question, and it's something that the smartest people in economics and government are still trying to figure out. Thanks so much for digging into this with me.